Hey everyone, hope you're doing well. Going to be a little bit of a different video this time around. As I've mentioned in the past, Craig Fuller is a former member of the Chart Guys. Now he's behind FreightWaves. They're really on the cutting edge in terms of the trucking sector moving towards blockchain integration and as well as moving towards futures pricing. So always interested in what's going on in that sector as it does begin to develop and try and innovate towards the future. But this is a headline from the website, freightwaves.com. And always a lot of good information there in terms of, whether it's articles or podcasts to be listening to. But this article got my attention. Just Wall Street panics. Sonar data shows why they are wrong. So I am certainly a technical trader using charts. I am interested in the fundamentals, more so when they don't line up with the technicals. And, a recent example of that is Tesla. Everybody's raising the red flag, fundamentally Tesla, but we have the stock price exploding and seeing short squeezes and all that. So I find that stuff interesting. I always want to see when there is a discrepancy between fundamentals and the charts, how it ends up playing out. So here is an example where they are, raising the red flag, so to speak, in terms of the market having it a little bit wrong the last few weeks with these stocks that we're going to look at, which are carriers, which have just reported some earnings. So first off, let's go over a little bit of the basics. The spot market, we're going to be looking at the spot prices for a bit of data, and that's what they're talking about here, the Sonar data. But the spot market is essentially, it's intelligence of trends in carrier capacity and pricing. So they use this information to come to agreements on pricing, and it's usually a good indicator of what to anticipate in the future with this spot price information. So if the rates are down, shippers win, and if the rates are up, carriers win. And these are all the carriers that we're looking at. So they want high rates. And July is normally one of the softest times of the year, and we're seeing a little bit of a pullback in the spot prices because of that, but we're also still extremely strong. So here is Sonar. This is another branch, FreightWaves Sonar. So it's a really cool system that, you have a whole bunch of data that you can track and charts and different things to overlay. Right now, I'm just going to keep it simple. We're looking at the DAT lax, which is the trucking spot rates between Los Angeles to Dallas. It's one of the most volatile lanes in the market, and it is also one of the lanes that is most exposed to the change in trade flow from different ports. So it's a good gauge of the general overall market, says FreightWaves, and I certainly am going to trust that that is the case because, again, I'm not very fundamentally intelligent on this sector, but I am learning. But one thing that stood out to me is the first thing I want to do is go back and look historically on this chart. So they have historical data. I want to see what happens, and I'm very easily noticing that things are very seasonal, and we can see here a very similar pattern shaping up from last year to this year. And what stands out to me is a cup and handle pattern here, which obviously, we're used to candlesticks. This is a line chart. But the psychology behind a cup and handle pattern is when you have a left side of resistance, consolidation, the right side is unable to break the left side because of how significant the pullback was. They need to establish a little higher low. This is the handle of the cup. And then you have a breakout breaking both the right side and the left side. So the basic principles, again, the right side is lower than the left side, healthy consolidation to form a higher low, and then continuation. So the left side of the cup back here was in November. We had the low in February, and the right side of the cup was in June. Here we are looking at these similar setups, I should say. November is the high. We have the low in February, and here's our lower high on the right side of the cup in June. So it's off by a couple of weeks, but the months are lined up. And look at the pullback we have right now. It is looking pretty similar to the pullback we had between June, and we bottomed out and formed that higher low in August. So here's our top in June, and we're going to look to potentially bottom out and form that higher low this month. So we can see that these spot rates are up near all-time highs. The all-time highs are up here in the 230s, and we got up to 230 again and pulled back. So I'm wondering if we're going to see the exact same pattern play out with new all-time highs and a bull break. If we break 230, it looks like we're going to see, a easy move up to all-time highs. But first we need to find our higher low and base out. So we're going to be looking for that to happen sometime in the next few weeks, potentially another month before that happens. But the bulls want to hold up. The closer, the better. So the pullback from 168 down to 136 is essentially 20%. And the pullback right now from 230, 20% off of 230 would put us down at about 184. So we're getting there. It's a very, very similar pattern. So I'm now very interested. I'm probably not going to personally be acting on it in any way. Maybe when there's a futures market, I will be. But I'm wondering if we're going to get this same kind of breakout to new all-time highs. And we saw this move occur from August and then we hit that high up in November. So potentially that August to November period, we'll see if the momentum shifts back and we head back up to 230. If that were to occur and we were to head to new higher highs, obviously that's very bullish for carriers, because the higher the spot rates, again, the carriers win. So that's something I'm going to be keeping an eye on. In this article, they also reference that on July 24th, TruckStop.com's chief economist, Noel Perry, he sent out a memo suggesting that the market was about to turn. And Craig was pretty adamant that the trucking sector is a really good gauge of the overall economy. And I certainly trust that. You know, I watch the financial sector and the tech sector for the S&P 500, and Craig watches, you know, all this intricate data of the trucking sector to get some picture of the overall health of the economy. And so this economist came out and said with the memo on July 24th that the markets were about to turn. And he was referencing data that is derived from a subprime part of the market, and it's a portion that isn't really, there's not a lot of exposure to these large carriers that we're looking at here. But they pointed out in the article that the data source that these traders and investors get for the trucking sector is limited to a certain degree. And so any little piece of data that they can get, you know, this feeds that TruckStop.com, that information feeds into Fidelity and all these brokers. So if you're getting a news flash, you know, that would be a potential news flash that these traders are seeing. And just looking at the charts, that July 24th, when that came out, that's when the sell-off started. So this is CVTI. This is one of the carriers that we're looking at. And it's not where the pullback started 724, but there was definitely a sell-off there. So this is the 3-day move. And just the percentage drop on that 3-day move, we're looking at a 14% drop. And we look over at WERN for the same action. And this is a bit of earnings as well, but obviously a ton of profit taking here. And I believe that earnings was on the 24th, but even if it wasn't, there was a gap up open and we pulled back 18% down to the low 1 day later. And last we got SNDR, and same thing, daily time frame. What happened on the 24th? Big time sell-off. It has since recovered. So we're going to look at these little charts in a little bit more in depth, but we pulled back 8% there. So the bottom line is this article hurt these stocks as traders and investors getting a little bit fearful. Maybe the market's a little bit toppy, time to lock in some profit. But the freight waves, they're saying, you know, the data that we're getting, everything in the spot rate market is still extremely strong, and that's what we've been using to forecast what to be looking for in the future. And we also have the previous history to be going off of. So they don't see any red flags in this market right now, which means perhaps that these bounces these carriers are going to see can get a little bit more follow through once the market settles down a little bit. They had great earnings numbers come out, you know, record earnings, and they're anticipating these earnings to remain strong through 2018. So I'm keeping an eye on the daily time frame, and here's a good example. We'll start with Snyder here, SNDR. They've changed the trend. Look at this daily trend of just clear lower highs and lower lows. We set a bunch of lower highs, and we just broke the most recent lower high. And this occurred on really the end of this most recent week. So this is a key resistance break. By getting over 2774, the lower high pattern has now broken. So we're going to look for a higher low to be established compared to 2551, and then to continue and confirm that the trend has changed, we'll look for the higher low, and then the bulls need to see a break of 2846. We can see a little double top here, 2846 and 2847. So we need a higher low on the daily. We closed near the low of the day on Friday, so we're not confident that higher low has been established yet. But once we find that higher low, if the bulls can break this little double top, they're going to be looking right back up at the all-time high. And that all-time high is up at 3052. So the start of the trend change on the daily in recovery, you know, at this point, getting back most of that bearish reaction to 724. So that's worth noting, the shift in momentum. These other names have not shifted their momentum. They took a big hit and they are recovering. You know, we've almost made back all of that 18% or so dump that CVTI saw, but there's still work to do for these bulls to completely regain momentum. So what I'm watching for is we formed a little daily higher low here, 2810, must hold short-term support. Definitely a red flag for the bulls if 2810 were to be lost from here. We've got resistance of 3003 and then a key level of 3099. If we can get back above 3099, it's like that July 24th sell-off did not even happen. A little bit late in terms of, you know, that 18% drop in 3 days was a really nice oversold bounce opportunity. And from them, we have already bounced 2636, and here we are over 10% higher in just a few days. So there's some really good volatility in these stocks. That is another reason that I'm interested in them, but a little bit late in terms of buying the immediate dip from the short-term oversold bounce. Now the play is looking, you know, do we get these spot rates following the same pattern as last year? And do we get these carriers responding to that with an increase in their stock price, anticipating good numbers in 2018 to continue? So those are the key levels on CVTI. And to wrap it up with WERN, looking at the big sell-off we had here and a pretty bearish day on Friday. There's a lot of bear volume behind this. So at this point, this is still the name that I would have the most caution on, with the bears still in control here. I'm looking at resistance of 38.5, and the must-hold support is 35.10. Potentially a play off of this support if we drop down on Monday and head right down towards this level. It's what we call a bottom fishing play. So if we were to get down, let's say, to 35.30 or 35.50, wherever there's an acceptable risk range where we would stop out if 35 were to break. 35.10 is support. I put my stop loss below that 35 psychological level because it's close, and that would stop you out if we drop down to a lower high and lower low. The bulls are going to be looking to form a higher low compared to 35.10 and see a break of 38.05 to shift that momentum back towards the bulls. And we can see the weekly time frame here. Again, close towards all-time highs. These carriers are certainly doing well. And we have a clear resistance level at the 40 mark on the weekly time frame, where the bulls have been unable to close above 40 at the end of any week. We've rejected now pretty much a half dozen times. So a close over $40, and we're going to be looking for all-time highs shortly after that. But the bottom line is all of these names are very close to their all-time highs, and they had that pullback on the 24th, which took a big hit. I would say SNDR is the strongest on the daily time frame in terms of starting its recovery. CVTI is in the middle, and WERN is still in the most control of the bears. But I'm going to be paying attention now to these spot rates, more so because I'm curious to just see, can this really mimic exactly what happened last year, except on a more significant degree, and get to those all-time highs again. So something interesting to be keeping an eye on. Again, at this point, I'm not, actively trading in this sector. I am taking it all in and increasing my knowledge base a little bit, and something to keep an eye on as we head forward from here over the next few months. Hopefully you learned something. I appreciate you watching, and we'll check back in at some point before we actually, probably as those spot rates, if we get back up, start curling and head back over $2, then we'll check back in and see where these carriers stand in that instance. Thanks again. Have a great rest of your weekend.